We are living in very interesting and volatile and uncertain times, which I think also creates opportunities for investors and for companies. And I think the purpose of this panel is really to get some insights on what you're all seeing and any advice we have on how to navigate this and come out even stronger. So I'll pass it over to Greg and Shu, my colleagues here, to get us kicked off.
Great. Maybe what we'll do first is have each of the panelists briefly introduce themselves, and then we'll start with some questions. Nimesh, I'll start there at the far end and work our way down.
Great. Well, thank you guys for having me. My name is Nimesh Shah. I'm a partner at Venrock. Venrock was started by the Rockefeller family in the 60s. We invest in early stage healthcare and biotech companies. I've been there about 10 years. I focus on late stage private and small cap public companies.
Great. So I'm Roger Kitterman. I'm the managing partner of Mass General Brigham Ventures. We have about $450 million under management, and our focus is really focusing on investing in spinning companies out based on the research done at Mass General Brigham.
Thanks for having me as well. My name's Craig Gordon. I'm a rheumatologist by background. I spent 3 years at an investment bank and then 10.5 years at one of the largest active managed mutual fund companies in the country. Then began my own firm where we invest in private companies and public companies globally. So we have investments across US, Europe, and Japan.
Good morning. I'm Jean-François Formula. I'm a partner at Atlas Venture. I've been doing biotech for a couple of decades. We manage $2.5 billion.
Thank you. And lastly, it's Shumit Mukherjee. Work with Bank of America alongside Greg. I run our equity capital markets business, and it's a pleasure to be here. So thank you. Maybe I'll start with a question here, and Nimesh, maybe I'll start with you. We've obviously seen massive shifts in the macro environment that has had massive impacts on how you think about investing. As you think about the impacts of macro to biotech, can you share some of your insights on how that's changed your investment process?
Yeah, so our process generally is there's two axes we look at. We want to find companies that are going after big problems or trying to find drugs that are addressing meaningful disease states where they could have really help patients. And then the second one is, can we figure out if it's going to work? So that, for us, has been consistent. I think what we've been focused on this past year more than others is, do these companies have the capital to get to these catalysts that's going to actually show us or give us confidence that it's working? And that's something we've been really working with our portfolio companies as well as any new companies to better understand. We've had a couple of companies come through the door and super exciting, but the amount of money they want to raise is not really going to get us to that answer. And I think we've shied away a little from those over the last year, just given what's going on in the macro.
Yeah, I would agree with that. And I would say that we focus on the science, and is the science going to help patients in a way that we can translate? And so fundamentally, deals are still getting done. Portfolios are stressed across the industry. That's not news. And so what we really focus on is where can we retire risk? And one of the ways we can retire risk is by syndicating very heavily. So whereas 2 or 3 years ago it may have been us and one other fund starting a company, now we're looking at, hey, why don't we add to another one or even another one after that once we're getting it started, so we can have a line of sight not only to the Series A but the Series B and beyond.
Great. Maybe shifting gears a little bit, obviously with this environment being more challenged, I think one of the misnomers is that there isn't a lot of capital. In fact, I actually think there's a fair amount of capital available, but the discipline in which investors are deploying in terms of investing has been much greater. As you think about some of the points that Nimesh made, and Craig, we'll start with you, what is some of the advice you're giving your portfolio companies today about navigating this environment, ensuring they have enough capital to keep their key programs going, and how do you see them emerging from that?
Yeah, I mean, the ecosystem has gotten a lot more complicated, right? So what I generally tell my companies, which I think hasn't materially changed for me over a decade of investing, is you're going to need the right management team, which sounds obvious, but yet is, in my opinion, generally lacking within the ecosystem today, or vis-a-vis the volume of companies that are out there, that you've got to have the right shareholder base that actually has truly a long-term horizon, which I think was not aligned with that the last few years, along with the right valuation. In conjunction with all of that, I think when people thought money was falling from the skies, they could do everything, and they can go into all sorts of numerous therapeutic areas, and they had the best technology, and I think that's changed. I think the bar for innovative improvement's got to be bigger, given the greater regulatory uncertainties, the greater pricing pressures that are out there, and I think sequencing is very important in terms of the pipeline and having a pipeline, and not just a one bet, but then understanding how you can manage that budget. And a lot of that discipline, I think, was lost out of the window the last few years. And you saw ginormous rounds at crazy valuations, and you saw very little improvements, right, in terms of either the data that was coming or increments that are being generated. I think all of that has structurally, we've got to kind of get back to the basics, what it was prior to the latter part of the last decade.
Jeff, would you add to that?
Yeah, I think the last point was very interesting, because the challenge, the advice to the portfolio company in the down cycle is always the same one as it has been for 20, 30 years, 40 years. Watch the runway, and the capital formation strategy is going to be affected by the different flow of capital. To your point, the aggregate amount of capital is there. Most of the late-stage private fund, venture fund, buy-siders have a lot of money. They're much more careful as to how they deploy it, because they've had bad return in 21, late 21, 22. But the money is there. But you have to look at when you think about strategy, first of all, don't change your strategy in a cycle. That's a classic recipe for funds that are saying, now we need to do that because the cycle is changing. The cycle will always change, and it's been the same thing for decades. So there is nothing new. But what's important is to look at the aggregate supply and the key component in our marketplace. Science, that supply of science hasn't changed. If anything, it's actually greater. Capital, we just said, supply of capital maybe have changed a little bit, but it's still plentiful. But talent, which is, if you have an oversupply of science or abundant supply of science, an abundant supply of capital, and the bar to start something is lowered, where a lot of people are rushing to the market, you're going to have a lot of teams that are not very well equipped to handle that capital or to maneuver once you get hit by the cycle. And I think one of the most interesting discussions I've had on some of those panels is sometimes a mismatch between the supply of science, the supply of capital, and the supplies of talent. And that's where every cycle is the same but a bit different, because those three elements are not always the same. There is different mismatch depending on the cycle.
The only caveat I'd say is that we talk about abundance of capital, but a lot of firms are stuck with a lot more private companies than they ever thought they would, because it was how quickly we can get to market. And now that that's a blast from the past of more of a normalcy of time to market, and I think while there's an abundance of capital, the companies are, the firms, the investment firms are having to nurture a much bigger portfolio than what they've had to think about the last few years. And that's also a different part of the equation as well.
And Craig, maybe a point to all of you who make investments in private companies and think about the path to ultimately having those companies become public. And with biopharma IPO volumes off appreciably, this year, 3 IPOs, last year, just a handful more. The dynamic you spoke about, which is companies remaining private longer. You're having to fund them longer and prepare them to become public kind of at a longer point in time than maybe what they originally thought through. What are you then advising your portfolio companies to do to wait out that longer path to becoming public? And then 2, how are you thinking about, as you said, the portfolio construction that you have, more private companies, maybe fewer public companies? What does that then do in terms of thinking about making new investments into private companies versus funding those that are remaining private longer?
For me. I think, now of course I have the advantage of when I started my firm in 2021, I didn't have the baggage of a ton of companies at what I would call many within the space a confusing valuation.
Yeah.
It's a very nice way to say it. I would say that in general, my view is private longer. I don't see, my view, a reason to go public until you have some human data, and the question of what that means is debatable. I think we've seen a lot of private companies go public way too early, and they have not had their house in order, either from a manpower perspective, but more often not a pipeline perspective, and that's created all sorts of issues now within the public small cap ecosystem. So I'm generally always more in favor of it, the private longer at much more reasonable valuations that leave you optionality as the company progresses to go public, because I do think the public markets are going to be, and the IPOs are going to be constrained for quite a while, because the small, mid-cap, unprofitable ecosystem still has not adjusted properly, right? For that ecosystem to stay afloat over the next 15 months, you need to generate at least $10, $12 billion, if not more. How is that feasible, especially in this macro climate, seems to me to be very perplexing. And so I think it's, how do you conserve capital? How do you manage the pipeline in your science and get to where you can have a considerable value inflection for either that private round or that crossover round, and leave you optionality to go public at some point in time?
Maybe I'll ask a two-part question with my two different hats on. So I'm currently the Secretary of Economic Development for our state of Massachusetts, but my entire career up until the last 5 months has been all in business. As an operator, CEO, CFO, COO, as a board member, and also as an investor in private equity and venture. On the investment side, I'm curious, when we look back in time, it's hard to know, is this now the abnormal time, or is the last few years the abnormal time? We had such a boom, and now we're on the other end of it, so it's hard to know which one is, or if neither of them is normal. But I do agree that this environment now creates some discipline and some focus, which probably is healthy in some ways. When we look back at past cycles, some of the best startups now were invested in right during the kind of the downturn. So I'm curious, seeing where we are right now, are there some opportunities? Are there some places that we should be investing now that are going to prove out to be really fruitful? And then a related question with my state hat on is I'm curious if any of you have any ideas of what the state should be doing to support these opportunities so we come out of this stronger. And we are very lucky here in Massachusetts to have, arguably the world's epicenter in life sciences. Are there things we should be doing in this down cycle to kind of ensure that we come out of this with an even longer lead? So two-part question with my two different hats.
Roger, maybe we'll start with you.
Sure. So on the first part, and I'll defer on the second one, I would say that it's normal. Both cycles were normal because it's a cycle, right? There are up times and there are down times. If you go back to 1999, it was like anything could go public with nothing, and then you couldn't, and then you could, and then you couldn't. So that's really normal. If you look back 5 years ago, I'd say that about 3/4 of the companies in biotech going public had phase 2 data. By 2021, that had flipped, where 3/4 of the companies going public were preclinical or phase 1. And so if you think about the 2010s, I would say the IPO window for biotech companies was closed a lot more than it was open. So these are normal times. It's just we're in a normal part of the cycle that's not at the uptime. But it will turn. When it will turn, these cycles tend to be long, but it could turn quickly, or it could, it's just very hard to predict. So you need to build companies that are really, built for that. If it's going to be a long time, that's okay, and if it turns quickly, you're ready for that too.
Yeah, I think I'd be tempted to say that they're all parts of the normal environment, because the cycles are part of the normal environment. And the interesting point you made about maybe some of the best company being created in the down cycle, I think there is some truth to it for a certain type of companies, because the criteria and the stringency for the good firm and others as well, hopefully, obviously is higher in a very tough market where there is probably much more scrutiny on the use of funds, the runway, operational efficiency, and more importantly, the probability of success. It has to be something very robust. Conversely, some of the very big vision companies that are very hard to start in an environment where you feel that the capital supply may be constrained. And whether it's a Moderna or an Intellia or an Illumina, or look back at Alnylam, which actually was started in a very tough market, by the way. And so I don't know why, if it's why it became a good company, but it was started in a tough market. But the fact of the matter is that to build those companies, you probably need to be benefiting from, at least in part, a very strong market, because the capital you need to build this company early on is much greater than to build some other type of companies that might be a single asset or single biological area, very focused, maybe traditional modalities, small molecule antibodies. And so I would say both type of cycle can, favor the birth of very good company, but different type of companies.
Yep.
The economic development, I can't really comment on that. I mean, it's hard in the private sector to kind of substitute for you guys' expertise in public policy. I would say that in Massachusetts, it's kind of there might be some more things to do, but it's kind of hard to do better. So not that I want to, throw you compliments, but when you look at other cluster or other countries, I mean, I've been involved a little bit in some of the French initiative, and I can tell you it's a lot harder there. There are a lot of things that they can do that they actually don't do very well, even though they're working on it. So here you have a bit of a bigger challenge because you're really trying to improve something that is already very, very good. At least that's my perception.
Great to hear, although we're not going to rest on our laurels. We want to be relentlessly working to get better, so thank you.
I mean, I have a bit of a different take. I mean, the concept of a cycle is normal. I think there was some, in general, starting in about 2015, valuation started going up for public IPOs and for public small caps. And private small caps, to be honest. And it really, I think, accelerated in 2018, 2019. And I think it got out of hand. I think what you saw in 2018 through 2021, I have some great data on it, is valuations going up on earlier and earlier companies that were not validated. The number of IPOs over a 2-year window were large, 2020, 2022. The majority of them were what I would view as more incremental innovation that was largely unproven. And I think you've seen in the last 2 years a lot of phase 1, phase 2 data disappoint, right? And I think, people thought FDA was easy and did not see FDA's change in its ecosystem. I think people expected deals to help bail them out, and I think that was concerning. And so I think, but some of that was also free money at low to negative interest, low to negative interest rates, right? That generate that, right? And there's no doubt there will be some great companies out of this, and there are great opportunities, and I see them. But it's, at least in our internal data, we're investing in 3 to 4% of the companies we're seeing. A very small number. That's just our process and strategy, but it does suggest that a lot of the companies we see, at least in our eyes, is not, is going to have a much tougher cycle. I think things that you can do, if you can fix FDA, that'd be great. They need more highly qualified people, and they need better retention. I think, honestly, the other thing I would say is there are lots of great ideas, but having the right human capital across, not just CEO and head of R&D, but even regulatory and manufacturing ops, that's definitely lacking. I'm not sure you can fix that either, but I think the amount of company creation and the acceleration in technology, some of which is clearly valuable and will be dominant over the next decade, the human talent is not necessarily keeping up with that. And that's definitely the case as well.
Yeah. Well, the good news is later today we're going to have Dr. Wergesen from the federal government. She's not from the FDA, but she's leading ARPA-H. She may be able to answer some more of those questions. And we definitely in the state are focused on workforce of all types as part of what's going to fuel our life sciences industry. And Nimish, I don't know if you wanted to comment. You didn't get a chance to comment on that last question.
So actually, I agree with Craig. I'll give you 2 anecdotes. It got so crazy over the last couple of years. There was one company we met, and at the time they're like, oh, we're super excited about what we're doing, but we can't tell you which targets we're working on. So we're like, okay, how do we do any work, right? But yet they were getting term sheets and they were getting interest. There's another company we met on a Wednesday. We're like, oh, wow, this is super exciting. It's targeted oncology. There's a high probability of success. They're like, yeah, we'd love to have you guys in. If you could give us, and we were early in the process, they're like, yeah, if you could give us a decision by Friday, that'd be great. And we're like, okay, so, so just the people were making decisions in very short time frames on limited information, and that it just did not seem sustainable. So those were, when I was hearing Craig talk, just those two stories, I just remember from that time frame, and I'm hoping that we can go to some more normal where you can do some work. And a lot of, those two companies right now are trading at cash, right? And now I assume we'd have a lot more time, a lot more, and we know what's going on, and we could do our diligence to decide if we'd want to invest. So.
Just another piggyback on him, like a lot of the investment banks love to comment, how many companies are trading cash, what a great opportunity. That may actually not necessarily be the case, right? Yeah. And I think, and I think that just shows you where we were and where we are today, right? Mm-hmm. And so just piggybacking on that comment.
Look, as an equity capital markets professional, I'm an optimist, so I'm hoping we return to normalization somewhat sooner. Yeah. And we get to a level of IPOs that create new companies at a regular pace. Look, I think, Greg, you touched on it, in 2020 when we were kind of emerging into this COVID crisis, there really was a driving force behind innovation and the need to innovate. And I think the cost of capital being what it was then really helped spawn that boon of IPOs where we saw 225 healthcare IPOs come over a course of 2 years. We can all agree that was too big of a number, including me. Innovation remains incredibly important. I think everyone here in the audience is working incredibly hard around innovation. As you span the field, what are the areas of innovation and technology and science that excite you the most as you think about that next cycle? And maybe Nimish, we'll start with you.
Yeah, so I think there are a number of areas that we're interested in. We have a number of plays in I&I, just because even though it might not be as innovative as some of the other stuff, there's validated targets and you can help improve the patient experience, right? So whether you have longer formulated drugs or taking injectables to orals, and those are diseases that impact many patients and very attractive markets. We have a private company in radiopharmaceuticals. We think that's an area that there's a lot of interest in just because Novartis has a drug called Pluvicto that has done really well and kind of created that space and generated a lot of interest in that space. But you can also, from early data, have proof of concept and predict whether this is not going to work or not. And then for us, we've always been big investors also in CNS. There's just so much white space there. I mean, it's really hard, but if you can crack the code, then there's a ton of opportunity.
Raj, would you want to add?
Yeah, so again, we're pulling from the research done at Mass General Brigham, which thankfully is very broad. But if you look at where they're really deep bench in both the amount of research done and interest from the markets, oncology is still a very strong place. Neurodegeneration, there's a lot going on there. Clinically, some interesting things happening there, and some of those insights being brought back into the labs. And so we have a lot going on in the CNS portfolio as well. The other thing I would add for us is that one of the things we did was we looked at the effect of the pandemic and some of the things we learned there in care delivery. So if you look at our Fund 2, we don't have anything in care delivery in our Fund 2. In our third fund, we actually are about to launch our third company where we said, that care that we used to deliver on site, we can do that same thing, high quality, but it doesn't have to be on site. And so let's bring this to the rest of the world and not just, you have to show up at McLean Hospital if you want a certain care pathway. So taking some of those care pathways, putting those into companies and launching those is an interesting area for us as well.
Yeah, I agree with them. I would also add, I still think there's a lot of interesting stuff going on in rare diseases, endocrine, for example. There's some exciting stuff going on. I would say that cardiology, believe it or not, I think there's still some exciting stuff going on there. So I would say it's broad. It's broad across therapeutic areas. It's broad across deliveries. I think it really, at least in my world, it's how do you making sure that it's the right delivery vehicle for the right target and therapeutic area where there's really truly an unmet medical need. I think certain spaces like radiopharmaceuticals is interesting. I think first to market can be important, particularly in the world of gene therapy and CARs. So I think picking that space is also complicated but interesting. So I think there's broad innovation. I think where, in my mind, a lot of the struggles end up being is the valuation, the capital, and the right management team married to all of that to get the job done.
Yeah, so we're totally agnostic, number one, right? So, and innovation is essentially pervasive. And as we said, the supply of science of innovation is not an issue, maybe even less so. Not that it was, but it's really very ample. So two sides. One is a biology, new biology, lots of opportunity. More things to drug or to impact, to change phenotypes. And then, of course, on the modality side, you have an increasing pool of modalities that are becoming much more established that you can essentially match with new biology. So it's a mix and match. You have an endless list of opportunity. If I was to pick, to be a bit more precise in the response, I think that gain of function modality, where essentially you restore, replace, or even, I would say, install some new biology. We're not there yet, but that's going to happen. And going from rare disease to not so rare to common diseases, I think the big revolution in medicine will be gain of function modality, whether it's gene therapy, which obviously was the first one, to gene editing and the next generation of gene editing, to even some oligo technologies that are very simple, where you can look at splicing, and you can actually restore as opposed to just loss of function. Applied to common disease is going to be a very, very big change in the field of medicine and healthcare. And it's happening. It's the beginning, but it's happening. So to us, that's something we're watching very closely because it's going to be a massive opportunity.
Exciting.
Maybe I'll ask each of you to comment on the regulatory and policy environment. Biopharma is regulated by a long list of someone put 3- and 4-letter acronyms between the government, FDA, CMS, HHS, et cetera. And the last couple of years have seen now very impactful or potentially impactful regulatory changes, IRA, as we've heard about in the conference, now a more engaged, so to speak, Federal Trade Commission. But as the four of you look at your portfolios, private and public, how do you look at the regulatory and policy environment in terms of where you'll invest, where you'll not invest, and how do you ultimately think about managing things that you can and cannot control from a regulatory and policy standpoint? Jeff?
Well, first of all, so we all know that different divisions of the FDA have different level of stringency and user friendliness, or lack thereof.
Yep.
And so I would say that for us on the early stage, we're not as concerned about that. It's all about the quality of the opportunity. If we believe that it's something that is really very strong and very innovative, we will still take the chance, even though we know that that particular division can be challenging. So you have to kind of match what you believe you can deliver to the stringency of the agency that you're facing, but it could be a good thing, because if you're good enough, you might get there, whereas lesser opportunity might not get there. So, I think for later stage investors, it's probably much more important to understand, to look at the POS, probability of success, as a result of the last few decisions and what you believe you can match from a regulatory hurdle and what you know are the requirements for that division. So I think it's a factor for late stage investors, less a factor for us. In terms of other public policy issues such as the IRA, it's way too early to assess the impact of the IRA. First of all, that bill has a lot of good elements, mostly the cap on Medicare Part D out of pocket, which was, it's outrageous that, people were going bankrupt, on the current rule, on the past rule, I should say. As far as the 9 years for small molecule and 13 years, I think, for biologics, we've been peripherally involved with the discussion in Washington. It was pretty clear that the staffers had some budget target and they knew what drugs they were probably going to have to include. And it also turns out that some of those drugs, which had already been evergreen for some time, particularly on the small molecule side, were a clear target, and they wanted to get there in certain timeline, which might have explained the 9 versus 13, even though frankly it's been a black box as to what that decision was made, and a number of people in Congress could not explain to us why that was the case. But the fact of the matter is that, you know, pricing has always been kind of a threat above our head, but we take a very secular view. No one wants to get sick, and everybody wants to live longer and healthier. And there is no amount of, you know, market cycle and political and regulatory cycles that are going to block the flow of innovation. Are we going to need to be more stringent as to the level of innovation we deliver to really get paid? That's probably the case. But if you look carefully through what might happen as a result of those reforms, it might end up in being a good thing for biotech, because pharma companies are going to have to renew their pipeline maybe more aggressively. So, you know, it's not a 100% win, but I think people are looking at the sky is falling. And first of all, we don't know that. And second of all, there might be some very good element coming out of that.
Yeah, I largely agree. I don't think the sky's falling. I mean, certainly the US FDA of US, Europe, when you look globally, US, Europe, and Japan is in the worst spot for a host of reasons. And that means more than ever, the quality of and the breadth and depth of management team is extremely important, especially as you go up from, you know, private as you go up later. I don't think the FTC is, you know, is a meaningful issue, to be honest, for the space. I think it's more noise than people like to talk about than reality. I think IRA is a problem for oral drugs more than anything that can, you know, or even biologics if you have multiple, if you're going from small to much bigger. And I think companies are going to have to think small, medium, large are going to have to think differently versus the past. How do you lean in, you know, based upon the target, right? Just to give a recent example, would Daiichi and AstraZeneca develop their HER2 breast cancer drug today, if it was starting now, like there was, you know, back several years ago? No, because it would just take too long given the rules of IRA. So you're going to have to think about, you know, doing it differently or scale the amount of capital that you have at your disposal quicker. But ultimately, if it's a really big innovation, and it's going to change physician and patient views around standard of care and therefore payers, there will be a return on investment.
Yeah, and I would agree with what's been said before, and also, you know, these are not new issues. I remember I was in a board meeting 10 years ago, and one of the board members asked the CEO if they were confident in their FDA strategy, and the CEO responded, "I would never use the word confident and FDA in the same sentence." So this has been going on for a long time. I would add on the optimistic side, you know, if you look on what's been going on with kidney disease and recently with ALS, where there's a willingness to look at biomarkers as a possible approvable endpoint for some of these diseases. If we can do more of that, that's really going to unlock a lot of things which we just can't invest in today.
Yeah, I agree. I mean, for us, it never played a big role because, like Craig said, if it's a drug helping a lot of patients, then it'll figure itself out. The two things we've changed recently is just with IRA, just helping our companies think through which indications to go after, because unfortunately now you start the clock once you go, and if you go after a smaller indication first. And then second, which is a positive, is the FDA, certain divisions have been just more accommodative. So stuff we might not have invested in the past, but now we're looking at just because the path is a little easier.
One last one for me. We spent a lot of time talking a little bit about the markets, capital formation, innovation, the regulatory environment. I think before we leave, I think it would be helpful if you guys could share some insights around your diligence process as these companies think about making that transition from being private to public. What are things you look for, whether it's diligence, the science, the technology, and as you think, and how all of that kind of percolates into assessing value? What are some of the kind of key characteristics that you can share? And maybe Nimish, we'll start with you and work our way back.
Yeah, sure. So our process is pretty straightforward. We answer three main questions, like will it work? So is it safe and efficacious? Will it get approved? And will it sell a lot, right? So it kind of boils down to if you're going after a drug that's going to really impact a lot of patients or a small number of patients, but in a big way, that's something that we're very interested in. So our diligence is very much focused on the science. We run a lot of clinical trial analysis, which is why it's helpful when there's some proof of concept from another drug or this drug itself. We do a lot of market research. And we just run that process over and over and over, and then try to find teams that could execute on that. So the first, like I said before, the two axes we'll always grade our companies on are, is it a big unmet need? And then second, can we get conviction it's going to work? And I think over the last 2-3 years, that's where we were much further on that risk curve. I think now we want to see some type of proof of concept from another drug or from your own drug that gives us confidence that it will work. But that's, we've always done it the same way for like the last 10 or 15 years, and we'll probably keep doing it for the next 10 years.
Yeah, we're a little different sitting inside an academic institution. So a typical deal will start for us with somebody from the BD&L team will come to somebody in the venture team and say, I just met with this PI, they have this idea, think it might be a company, what do you guys think? That's kind of where we get started. So there might not even be any IP filed yet, but it's really, can we envision a company here? How would we pull together? What indications would we go after? And does that story make sense? So we do our diligence through that process. But that's a relatively short process, and then it comes to company building. So can we find the management team, and really the longest step in there is can we syndicate? Because we have to take something to the market, of the financial market, and say, okay, we like it, we believe in it, but can we get others to believe in it as well? And in normal markets, that takes a long time, and in these markets, it takes even longer.
Yeah, I mean, similar to Mesh, my due diligence process really hasn't changed, right? Yes, of course, the science is important, the unmet medical need is important. And making sure you gauge whether or not it's a true medical need, how you do that is important. I think valuation is also has always been crucial, and I have a certain desire in my mind, at least, of what I'm looking for in terms of return, and if I can't pencil it out where the valuation is, then that's a problem for me. And the management team is important, particularly if it's more of a novel technology, being able to navigate the regulatory process, even if it's just around manufacturing, forget about clinical trials. So I would say where it's probably a little bit unusual is even the private company side, gauging the unmet medical need, what are payers going to do in the US? There's a lot of great stuff out there to kind of gauge that, even just the therapeutic landscape and what's needed, and therefore the capital that's needed. I think that's really important.
Yeah, so all of the above, but in our case, because we're mostly doing company formation, the due diligence is actually diligencing us as an idea, which is we do the wet work literally. So we have a couple of sales company right now where the idea came from inside our closed network, and we need to do some wet experiment to see if the science is as good or the idea has leg. Mm-hmm. And so, but then when it's something that comes from the outside, it's very close anyway, so it's a bit seamless. Whether we're the one doing the work and then we're judging our own work, or whether someone comes with a paper, and then of course we'll reproduce the data in exactly the same way that we do de novo experiment for something that came from the inside. Mm-hmm. And then the rest, all of the above applies. Unmet need and line of sight of translation.
Right,
while we're all great panelists group here, we all love each other, I will say, all kidding aside, due diligencing the shareholders is important.
Yes.
Right, understanding who you're getting involved with at the board level and the shareholder, and what their mentality is and their investment horizon, very important.
I always say to founders, it's not just the cash, it's actually a marriage. And so choosing the right partner is hugely important. We just have a minute left. Speed round to end. A year from now, at this conference, when we're all back here, one prediction about capital markets, each of you.
XBI will be, I think, twice what it is today.
I think it's going to be an active stock pickers market, privately and publicly. I think you're going to see a lot of innovation and I think even commercial wins, but I think vis-a-vis the size of the ecosystem, it's going to be a smaller percentage where more are going to struggle.
I would say something similar to that. It'll feel a little bit better than it does right now.
Yeah, I agree. I think the capital markets will be modestly better. There'll be more IPOs, but the secondary market will be very similar. Just the winners will be able to raise, others won't.
Great. Well, on that note, thank you all so much. It's super fascinating to hear all of your perspectives, and I think everyone gained some words of wisdom here. And thanks again to our Bank of America partners. And we'll all see how we navigate this and how the predictions come true or not for a year from now. So thank you all so much.